me, the best part of my Real Vision journey has been the chance to refine my own investment framework through a series of conversations with brilliant investors in every corner of the globe. In this series, I want to try and continue my education by digging deeper into the lives and careers of my guests to try and learn how they think. I want to understand the experiences that have shaped them, the failures they've bounced back from, and the lessons that those failures have taught them. And I want to break down their success to find out what sets them apart. I'm not looking for trade ideas or guesses about an unknowable future, but rather knowledge accumulated over the course of careers to try and make me a better investor. And I want to share those conversations with you. While finance is an ever-changing landscape, with different strategies gaining popularity over time before either flaming out spectacularly or gradually waning in the eyes of investors, there's one discipline which is constant throughout. Over the course of my career, I've been drawn to value investing like a moth to a flame. There's something about the search for truth in a market and in companies that speaks to me in a way that other disciplines simply don't. The level of research and patience required to successfully practice what is the most fundamental of investment styles is enormous, and it tends to forge investors who have character and fortitude, as well as a healthy level of skepticism, all of which I personally aspire to. Today, I'm traveling to Fisher Island in Miami to talk with a wonderful man who's become a dear friend and who's taught me much during the course of that friendship about what's required to become a successful value investor. He began his career in a world which investors today simply wouldn't recognize, and over the last 40 plus years, he's learned his art from the true giants of the value investing community. So please join me for a conversation with William Strong. Bill, I'm used to saying welcome to people to Real Vision, but here we are in your beautiful home. So I guess thank you for having me as a better way.
We'll invert that. I'll welcome you.
Well, it's very kind of you to have us.
To have you here.
Now, you and I have been trying to get this together for a long, long time, and I'm delighted we finally got the chance to sit and talk, because this is going to be something that I think people are going to be surprised about, because a lot of people watching this won't know who you are, won't know your story. I do, which is why I'm desperate for them to get the chance to share it. So, as I always love to do, let's go all the way back to the beginning and walk our way through, because it is a fascinating story.
Okay. Well, I try to, in thinking about this, I try to think about how to frame this and start at where is the beginning, I guess would be the issue. So one of the points I want to make is that if you take the graph that you present in your magical, what is it, the presentation?
The World of Pure Imagination.
Pure Imagination. And then when the debt line diverges from the GDP line. Yeah. That's where I started. Right on that exact point. So I started in the investment business in 1972, right after Nixon went off the gold standard. And so my career has spanned that entire time frame. And that's what we're going to talk about today, because there's lots of stuff that go on in those years. But I didn't start there. One of the things that in looking back over my lifetime, and one of the things that now is clear to me from this long perspective, is that I've always been, for some reason, particularly achievement-oriented. There's some deep insecurity somewhere that's made me really want to accomplish things. So I think I've told you. At 10 years old, I was a competitive swimmer, and I had some national records in competitive swimming. In high school, I was a student council president, national merit finalist, swimming team captain, and all of those things I was motivated to achieve and to excel, and that helped me get out of Tulsa. So I got to go back east to college, as my mother really wanted me to do. I went to Williams College in the late 60s, which was a shock. This conservative, wholesome middle American, and this was the time when the counterculture and the anti-war stuff and all that. So I went through Williams College and got a degree in economics. Spent 6 lovely months in active duty in the Army Reserve, and then went to Wall Street. And in those days, nobody went to Wall Street.
No, exactly right.
It was out of favor. Nobody thought that was a good job. And I ended up in the bond business. I worked for Citibank for a year, and then I ended up with a middle-sized firm called Loeb, Rhodes and Company. I got hired by this wonderful guy an Italian kid from Brooklyn named Tom Ambrosio, who became the partner at Lobroads in their muni bond department. And for some reason, he hired me as a very young guy, and I ended up as a bond underwriter. So in the early 70s, I ended up in a position where I was making decisions about interest rates. Really, I didn't really remember that much from my undergraduate years. So I went up, I took some classes at Columbia in the evenings about monetary policy and stuff. I actually read Milton Friedman's, or part of Milton Friedman's history. And ended up spending 5 years in the worst bond bear market, the world has ever seen. And it was pretty surprising and pretty shocking. We ended up doing okay.
Well, let's pause there, and we'll get back to the timeline shortly, because I'd love to talk about what that's like, a really bad bond bear market, because we haven't seen one since then.
That's one of the reasons,
And it, that could be in our future. So let's flesh that out and talk a bit about what that felt like and what was happening at the time.
Well, we had my only orientation to interest rates was a macro class I'd had at undergraduate, and so this was the idea that as the economy began to slow and we go into a recession, I guess it was 73 or so, 74, I was sure interest rates would go down, but they didn't. They went higher, and then they rebounded. The bonds rebounded coming out of the next recession. But the experience was one of really surprising, constantly higher interest rates. We were sure that rates had gone up so much that they couldn't possibly go up, and they did. And one of the things that most people, I think, didn't pay enough attention to was this distinction between real and nominal interest rates. So we had accelerating inflation and accelerating inflation expectations. And that meant that the real interest rate was not nearly as high as we considered it to be because the nominal rates were so high. So in this environment, I think, again, this is an important point to raise, because I think nominal rates and real rates are important. Just that distinction may become pretty important as inflation accelerates. But in those days, rates went so high, and it was really, really difficult. One of the main experiences I had was the bankruptcy of New York City in those days. And that was a shock coming out of a liberal education in the East Coast, economics department of Williams College. They're all a bunch of Keynesians, and it was all about, stimulating the economy and redistribution. And so to end up in New York City, where they were so clearly flagrantly misrepresent or misspending the money and not raising the taxes enough, and it was obviously a real mess. And that was a real surprise to me. And they actually did go bankrupt. So,
but what was the feeling around? Because you would think New York City would be the epitome of too big to fail. You would think,
right? Well, this is
So was that really the kind of pervading belief that there's no way New York can go bankrupt?
No, this was a different time. A very different time. And there was a headline one of the days that Gerald Ford had rejected bailing out New York City. I forget the headline, but it was all over New York. The president of the United States had refused to bail out New York City. And so there was a conscious decision made to let the city go bankrupt. They didn't call it that. They restructured the debt. But short term, New York paper was trading at 25-30% interest rates, yield to maturity. And actually it turned out to be a good purchase. And they ended up restructuring it. We can go through the details, but the idea that it was too big to fail nobody even mentioned that. I shouldn't say they mentioned it. They didn't really think of it seriously, and the president said, "No, we're not going to do anything," and so that's what happened. So some people lost some serious money in this. It turned out they restructured in a way that in the long run it wasn't so bad. But this was for me in my youthful neophyte experience that was really, really a shock. I didn't think this could happen. So I ended up deciding that I didn't want to be in the bond business forever, and I went back to business school. 1977, I left Wall Street to go back to business school, and I enjoyed your interview the other day with David Stockman, who at that point in my life became sort of a hero for me, because I'm now very disillusioned with the education that I had at Williams, and about about the economic outlook and what was going on in the government that's accelerating inflation, bankruptcy of New York, and I was amused that I too had thought about going to divinity school to avoid the draft. He actually did this, and he went to Harvard Divinity School, but I didn't do that. I actually went ahead and went through the Army Reserve, which was probably a healthy experience. But coming out of the business school, I went to work for a small firm, and we'll come to that in a minute. But Stockman represented a real refreshing change in the way people thought about government, and I was impressed with what he was doing and what he was saying, and I really enjoyed the interview with him the other day because his perspective today is very similar to mine. That this has all happened. It's all gone on for whatever it is, 30 years or 40 years, beyond what he was doing in those days. I thought Reagan and Stockman were really going to change things, but they didn't.
Well, I think they did too.
They did too.
Yeah.
But things have gone on and on, further and further in this debt growth and all this direction. So I got out of business school, and I was coming out of business school in that last semester. Everybody looks for a job, and I ended up getting the notice that there was a small firm in New York that was looking for an analyst, and my investment management professor said, of course, we all know that markets are efficient, and so these guys are wasting their time. Right. There's nothing to be gleaned from active management. But if anybody's interested, here's the phone number. And anyway, I think three of us, this was a class of 60 or 70 people, I think three of us applied for this job. And I have to say, I just lucked into this, getting a job. I had an interview with Bill Ruane and up in Boston, and at the end, he said to me, he did most of the talking, and at the end he said to me, Bill, I'm friends with this guy, Warren Buffett. And I literally said, who's that? I don't know who's Warren Buffett. Right. Well, it turns out I went down, I spent a day with him, and I got the job, and three really smart, interesting people doing interesting fundamental research, and find out later, Bill Ruane had been in the same class with Buffett in Ben Graham's seminar in New York. So they knew each other for years. They had invested similarly in New York City. Well, Ruane lived in New York. So he and Buffett had been doing stuff together for years. And when Buffett closed his partnership in the late 60s, some of his partners said, well, what should we do with our money? Ruane was starting a mutual fund. And so Buffett suggested that those people give their money over to Buffett. And so that was really to Ruane. To Ruane. So that was the genesis of Ruane's mutual fund called the Sequoia Fund, which had started in 70, 71. And pretty soon had some really poor performance. This was the Nifty 50, and the stock market had already turned down, but the Nifty 50 kept going up. So they had a couple of really bad years. They almost didn't survive. And then in 1975 or 6, they had the best performing fund in the country. So this is one of these examples of this cyclicality that you have with value investing, which is out of favor for a while and then it does really well. So and I've had this experience as well, which we can talk about. But I ended up there in the late 70s, got this job and was one of the only analysts, the young analysts that they had, and it turned out to be an amazingly good piece of fortune.
Yeah, I mean, so let's talk about their style, because there'll be people out there that won't know Ruane. Yeah. They won't be familiar with him because he's not as well known as his classmate Warren Buffett, obviously. Right. Talk a little bit about them and what you learned from that.
Yeah. So one of the major thrusts of Ruane and of the Buffett in those days, Buffett had changed over from being strictly a deep value investor to one where he's looking for higher quality businesses at maybe a little bit higher valuations. So by the time I got involved in this, they were looking for businesses that had very good returns on capital. That's the key, and we're doing the same thing. You want to have very high returns on capital. At the same time, you just don't want to pay for it. So you want to be something that's really cheap, but really good businesses. And so those are, we can talk about Michael Porter's definition of strategy and all that sort of stuff. But essentially, we were looking for companies that generated high returns because they had a sustainable competitive advantage. But you didn't want to pay for it. And of course, in those days, everything was cheap, so that wasn't such an issue. I remember one of the things that I worked on early on was I looked at Gillette, which has obviously a branded franchise, and we were trying to figure out whether we should pay 6 times earnings for it.
Right.
And I don't remember if we did, but we were doing things like that. But I think one of the key lessons from Ruane Cunniff was this idea of a sustainable competitive advantage at a discounted valuation. And that's one of the core of what we're doing and have done. But the other thing, in those days, remember, inflation was very high. So one of the other things that they did was to have businesses that didn't need to replace capital as they grew, or as inflation grew their revenues. So they were big fans of media businesses, both television or newspapers, magazines. We owned the Washington Post, and we owned Cap Cities Broadcasting. And I just was a fly on the wall, but I sat in these meetings with Katharine Graham and Tom Murphy, and these are the superstars.
Sure.
You read William Thorndike's book about the Outsider?
Yes.
So I just was lucked into having to be there while these people would come. They came by every couple of weeks and sat around and talk about what they're doing and what they're thinking and valuations of various kinds of properties. And in hindsight, and these were some of the real superstars of the management, the managements that we were looking at Ruane. But we had other companies that are also very, very profitable and high return on capital. And this worked really well over those years. But also remember, that was a time where we just had cash. You were getting over 20% on that.
Yes.
So it wasn't so hard to do well on an absolute basis because everything was so cheap. Interest rates were very high. One of the things that they had me doing when I first got there was looking at Ginnie Maes, which were yielding, these are pools of mortgages that were yielding 18%. And my job was to try to figure out which ones, they obviously were selling at big discounts because the coupons were much lower. And my job was to figure out which ones were gonna pay off quicker, because then the returns would be much better than 18%, because the duration of the bond would be less. So we did that project. They also had me looking at Fannie and Freddie and some savings and loans. And again, this is an environment with 20% interest rates, short-term rates, and it was just killing the savings industry and Fannie and Freddie, because they had 8% long-term assets that were funding with 20% short-term deposits. And it was clear this policy of high interest rates couldn't last. It would bankrupt the entire country. But in the meantime, it was really painful. I used to do just on my own. I went through the S&P tear sheets. This was before the computer days. Every stock had one page in either one of the books about the New York Stock Exchange, the American, and the over-the-counter markets. And I looked through every one of those pages, so every company that traded in the stock market. And I came to understand that the really good return on capital could be quickly seen on those pages as a 10% return on assets. So I was looking for a business that routinely generated 10% return on assets, and then I'd look at the valuation, and if it was cheap, I'd get interested. They could do this very quickly. And there aren't very many of those.
Sure.
Then, now, ever. 10% after-tax return on assets means you're doing a 13% or 14% pre-tax. That's very, very hard to do. Very profitable businesses, very hard to do. And I think about it now, so those were the very best kind of businesses. And there were, 2 or 3% of the whole book was that kind of. Everybody else was lower, some were much lower. And all of those assets were being financed with liabilities or the carry cost of 20%.
Right.
So imagine you have assets that are generating 6, 8, 10%, And the bank interest rate is 22. So even if you're not borrowing from the bank, you should be selling your assets and putting your money in the bank.
Yeah, exactly.
And that meant that the economy was just you could feel it. It was just getting crushed. Liquidity was getting sucked out of companies. Companies were shrinking their assets for this simple reason. And so you knew that there was going to be a recession, which there was. You knew it would go on until these interest rates came down at least below those kind of returns. And that's what happened over the long run. And it did squeeze inflation out. So it was a very painful time. The tight monetary policy of Volcker was crushing all kinds of businesses. But for us, with cash and liquidity, the stock market went down. It was a good low risk.
Well, but that's a constant. It's interesting you bring that up. Having cash and liquidity that's never a bad position to be in. It doesn't matter what the market conditions are like.
But imagine you're getting 20% on it.
No, sure.
As opposed to 2 or 3 or nothing today.
But you spoke there about how it seemed at the time that you kind of said, well, we know rates can't go up forever. And we found ourselves in the last 10 years saying, well, we know rates can't go down forever because they get to zero. And yet, we've been surprised at not only did they go below zero in some places, which was astonishing, but just how pernicious that drawdown and that bouncing along the bottom has been.
And it's lasted for so long.
Right.
And the consequences are exactly the inverse of what I'm just talking about.
Exactly right.
So the liquidity is pouring into things instead of pouring out.
Yep.
And so you have all that kind of behavior that you're seeing today. And unlike, this is my opinion, unlike what we saw in those days where we knew this wasn't going to last, my sense is more and more people are assuming this is normal.
Yeah, and will last forever.
And will last for a long time. And
yeah.
so I think that's one of the interesting opportunities that we see, because we don't think it's going to last forever for all kind of reasons, as you know. But I think the experience that I had there in the late 70s, early 80s, and in the bond market, was really the inverse of what we're seeing now. And again, it's not going to last forever. We have these extremes on either side of the yield interest rate spectrum, and the liquidity that's implied by those interest rates. In one case, none, and the other, lots.
Yeah.
And the effect that has on businesses and financial asset valuations and so on, I think is one of the messages that I take from the early years. I just apply it's the inverse today, and that too, these two will change.
The environment in which Bill cut his teeth is not only unrecognizable today, but it's virtually impossible to conceive of a way we could ever get back there. But his formative experiences with Bill Ruane and Richard Caniff in the early days of Sequoia gave Bill an ability to cut through the market noise and look for something which is always there if you look for it: true value. It's essentially a simple discipline, but one which would, over the course of Bill's career, fall out of favor dramatically. So I wanted to find out more about how Bill saw that.
So that that value bent that you kind of fell into when you ended up with Ruane, that's something obviously that stuck with you.
Well, I kind of come across it at business school. We had some cases. I took this investment management class, and there was 3 days on Ben Graham, because the other 70 were all on efficient markets. And the markets are perfectly efficient, and there's no. But I had been introduced to this at business school, so this made sense. The idea made sense, and when I was talking to Ruane about it, this was the first thing he talked about. Jean-Marie Evelard, my friend, has written a book, his memoirs, and the title is Value Investing: It makes sense and it works.
Right.
And that's all I know to say. It makes sense. The logic makes sense to me, and it did then. And we'll come back to this in a second. But the other thing that's independent of that is that the results of value investors over long periods of time have been excellent. They've been really good. They've outperformed. Put those two things together, I think it's a compelling strategy.
But it requires something that is in such short supply today, which is patience.
Patience and discipline.
Yeah, and that's what I find so interesting. That's why I'm drawn to that style of investing too, and why I love talking to value investors. I interviewed a great friend of mine, Dave Iban, a few years ago in San Francisco, And I was listening to Dave talk about how he does this and his framework and stuff. And you know, I kind of found myself saying, without really thinking about it, you know, when you talk about this, it seems so easy. And value investing really does seem easy. You buy stuff when it's undervalued, and you hold on to it, and you sell it when it's overvalued. Mm-hmm. But we both know it's not that easy. But the difficult part of the discipline is it's all up here.
Yeah. You know, well, this is I've thought a lot about this, because you're right. Buffett used to say, you know, you can't persuade someone to be a value investor. Yeah. You either get it or you don't. And I've had that experience over and over again. Some people it just doesn't. And I think one of the variables that makes it difficult for a lot of people is that value investing requires a leap of faith.
Yes.
And that leap of faith is that at some point, the fundamentals that we do, that's the work we do, is coming up with the fundamentals. Those fundamentals will be reflected in the stock price. And that's not always the case. So there have been some exceptions to that in my career. You spent time in Japan. Valuations don't always end up being reflected in stock prices, or even stock prices or valuations don't influence managements. You know, we've gone on and on about the Japanese and to some extent the Koreans. But the idea that at some point, this kind of goes back to market efficiency, value investors don't believe markets are perfectly efficient, but they don't believe they're inefficient either, perfectly inefficient. Because in the first case, if markets are perfectly efficient, I'm wasting my time.
Yep.
And in the second case, if they're perfectly inefficient, I'm wasting my time. Right. So there's over time, markets will become more efficient, and valuations will come back to where they're. That's a leap of faith.
Yep.
That we just accept, and in my experience, it's almost always been true. You have to think about it sometimes where it might not be true. But I think that's one of the things that people that amateur investors or novice investors may not appreciate that leap of faith, or may not have that leap of faith. They may not know what the fundamentals are. So that's one of the things I think it distinguishes value investors, have this faith. There's a corollary to this that I think is interesting, and that is if you're patient in terms of holding a stock, you also have to be patient in terms of not holding stocks or owning cash.
Yeah. So
you have to also believe from time to time there will be opportunities to buy stocks cheaply. Even if you can't do it today, you have to have faith that at some point it will be cheap again, and you can redeploy that cash.
Yeah.
And again, that's part of what we do and part of the way we think, and it's certainly been my experience over the years.
Well, we're getting back to you, because we're coming to a very interesting juncture in your story now, because we're getting to the point where this 35-year bond bull market starts. And so I'm interested in hearing what it was like at a big trend change like that, because it's only happened once in the last 40 years, right. A trend like that. So let's talk about your experiences at that time, how easy it was to understand what had happened and where it was going, or was it a real struggle for people to buy into the fact that, okay, it's changed, the environment has changed now, and you have to think differently?
As you know, by I guess it was 1982 or 81, I guess you could buy 15% 30-year fixed rate non-callable treasuries. My boss my muni bond boss from years earlier went out and loaded up his IRA with those bonds, and never did anything else. He just would lock down that 15%. But I think at the time, again, as a value investor and as a contrarian, as value investors must be, and you do the arithmetic, we felt pretty comfortable that this was a great opportunity to buy financial assets in general, bonds and stocks, because they were all being crushed by these interest rates, mm-hmm. and real interest rates at the time were extremely high. I think you were getting 3, 4, 5% on treasuries and 3 or 4 more on other bonds. And so you could do the arithmetic. Inflation would have to really take off for you just to break even.
And take off from double digits.
Yeah, they were already 12%. And at the same time, I told you, I've had this experience with Volcker's interest rates, short-term rates, were crushing the economy. Yeah. You can be pretty sure that inflation was not going to take off. it was probably going to come down. Also, I was trying to find the other day, somewhere from that time horizon, I have an old Barron's that I put away in a file, and I couldn't find it, but you'd get a kick out of this. The Barron's was much thinner in general.
Right.
There were 2 pages of equity mutual funds. 2. No ETFs, just 2 pages of equity mutual funds. And all the advertisements in this were for gold, gold bullion, and buy small oil stocks that were taking off, and all of those things which had done so well during the 70s. And again, as a contrarian, you could be fairly comfortable that this was not going to continue, given the high price of oil, the high price of gold, the high yields on the bonds. All of that seemed to us to be making the change actually in the economy, and the inflation and all that was starting to happen. And so as soon as the Fed started cutting interest rates in, was it August of '82, I think?
Yeah.
I remember there was a week or so where you could see they cut rates a couple of times. This was a clear signal that they were going to loosen, and the economy, the wheels were coming off the bus. I mean, it was really bad. And so at that point in time, I remember I stayed at the office one night till about 10 o'clock, making up a list of stuff I wanted to buy, and I bought it the next morning. And I didn't have much money, but it was pretty clear that this was going to turn and change. But of course, most everybody else was skeptical, because it's been 10 years. This was
exactly
15 years after the peak of the bull market in the 60s, when Jack Dreyfus sold his company. So this was a point in time where everybody had been washed out and everybody was pessimistic. Interest rates had started to come down, but everybody thought that was going to be temporary. But I think you could see the fundamentals were finally starting to kick in to make interest rates come down. And we were still in a recession, but it looked like that might be bottoming. So we thought that was a pretty good opportunity.
So how do you talk about how you pull the trigger? Because when we talk about this now and you talk about that scenario, it's very easy for us to sit here today knowing what we know about where that move has taken us to say, well, that's an easy decision to make. I mean, obviously, with rates there and the economy doing what it was and stocks where they were, it's easy. But still, whenever you're in the middle of those turning points, it seems so black everywhere you look, you're around you. How do you find or instill the discipline to write that list and to the next morning go and execute those trades?
I think in the end, Grant, it comes back to this faith in value investing. I think in the end, that trumps the sentiment. It has to seriously trump the sentiment that's all around you. And so when you believe that valuation and the rational valuation of things is so out of line with the stock price, you just see that as an opportunity, and you can ignore the general sentiment around you. There's also the fact that, and I've seen this over and over again, the negative sentiment is creating an environment that's going to heal the economy, bring down inflation. So if you only pay attention to the sentiment at the moment, you may miss the turn in the overall economy and monetary environment and so on. But I think the short answer is that if you really believe in valuation as a way to think about investing, it's fairly straightforward. And if I can jump forward to 2007, 8, 9.
Do you know what? I was just about to do that.
So that was,
I think you're going to answer my next question before I ask it.
Yeah, that was a really big example of that. So we'd put on a lot of shorts against the housing bubble. It was pretty clear there was a big bubble, and we were short the home builders, the mortgage originators, the guarantors. We were short some of the banks. We were short the investment banks. We had an experience where we were looking at the shorting investment banks who were packaging the mortgages, and so we looked around and we thought, gee, that's just worrisome. Goldman Sachs is our prime broker, and we're shorting their stock.
Yes.
So we went down to see them, and my young head of research, Steve, went down and had a meeting with their IR people, and he was talking to them about details about the 10K and stuff about the what they were doing with these mortgages. And at one point, the mortgage guy, the GS guy said, "Look, I know what you're trying to figure out. I know what you want to know. We're just not going to reveal this to you. We're not going to talk about this in our balance sheet. Sorry, but that's the way it is." So we came back. We were already short the stock. We came back and we moved almost all of our assets over to the Northern Trust custodian account. And a year later, Goldman was on the edge.
Yeah.
Anyway, so when you do that kind of work, you know this stuff pretty well. And so we had longs in emerging markets and some commodities and some other things that we didn't think would be affected by but when the crash of 2008 happened, I mean, again, I'll never forget. Again, this is a liquidity event.
Yes,
exactly. And it was just, again, you could just hear the dollar liquidity sucked out of the system as Lehman collapsed and all that stuff collapsed. There was a dollar shortage everywhere in the world, and assets that you would never have imagined would be affected by what was going on in the housing industry here. And we had this wonderful bank in India that went down 70%. Mm-hmm. It was fine. There's nothing wrong with this bank. Yep. And the reason why is it was heavily owned by U.S. hedge funds, and they were getting redemptions, and so they sold the stock, and the stock went down dramatically. Anyway, so as 2008 came, we had a significant short in the U.S. housing area, and it was starting to work, and we were starting to make some really good money. So the first ones to go out of business were the IndyMax and the originators. They were gone. We were short Bear Stearns. We were short a lot of this stuff. And then as the year progressed and these stocks really got crushed, by the late fall of 2008, we looked around and the longs we had were just getting creamed, just destroyed. So we made a decision, and it wasn't difficult because, again, we believe in value investing, to cover the shorts and put the money over on the long side. So we went from 40% short and 80% long to, 110% long, 5% short in late 2008, 2009. And that was maybe the most profitable decision we've ever made.
Right.
That turned out to be a home run. And it wasn't so much about thinking about the market as it was just these stocks are so cheap and they're so attractive. These are really good businesses. We know them well. And so we shifted our asset mix from one side to the other. The shorts went down some more. We did have some more declines in the shorts, but the longs took off.
Well, yes, I really do find this interesting because the principles are the same, but being a contrarian and a value investor on the long side versus being a contrarian and a value investor looking to short the market are mentally two very, very different disciplines. Because if on the long side, you own something. And so you can see value and you hold something that you believe to be valuable. Shorting an overvalued market when your downside is unlimited requires a very different mental discipline.
I want to make clear, I confess, I am not a short seller.
No,
I don't do this. I don't do this very well.
Yeah.
I don't do it very often. I almost never do it.
Yeah.
And I did it in the late 90s, and it almost put me out of business. We can come back to that in a minute. But you're absolutely right. Shorting is not the inverse of going long.
Right.
And the arithmetic is what it is. There's all kind of other things about it as well, as there's all kind of short squeezes and other structural things that are a problem. Shorting, we don't do it very often, and the valuation is one element, but it's only one.
Yeah.
And so the valuation is where you think the value of or the price of the asset's already close to where the high it might be. And in the tech bubble, we were shorting tech stocks, and that was a huge mistake.
Yeah.
Because there is no limit to what the price could be.
Discipline, patience, and faith are the cornerstones of value investing, and having all three, particularly at turning points, is the key to lasting success. Never is that truer than at extremes, and as Bill intimated, the extremes of the late 1990s would teach him a very valuable but extremely painful lesson.
let's go back to the 90s because I think your lessons there are very, very interesting.
Yeah. So again, we took a value approach, we took a value perspective, and decided that these tech stocks were crazy overpriced, and we could do the fundamentals on the companies. We knew they weren't doing very well, or in some cases they wouldn't survive.
Yeah.
And you could do all that, but in the meantime, the stocks would double and triple anyway, and you'd be forced to cover them, even though you knew you're right. And this went on and on and on, and I can't tell you that we had 6 out of 7 years when I started Equinox, we lost money.
Yeah,
it's amazing that we survived at all.
Sure.
And that's the most difficult time I've ever been through, because again, if you apply a rational approach and you think about rational ways to think about investments, none of this made any sense, and it didn't make any sense in '96 and '97. Right. And by '98 it was crazy. In '99 it was just. I remember in early 2000, I woke up one morning and looked at the New York Times in those days, had little columns. It showed the 10 best and the 10 worst performing stocks. So I looked at the over-the-counter stocks, and of the 10 best performing, 8 of them had gone up 100% or more the day before.
Right.
I mean, how do you process that?
No, sure.
This is insane. I don't know. I thought if we'd been short one of those, we'd be out of business.
But it's even more insane to a value investor. If you're just a guy that trades around, you kind of look at it and you're fairly agnostic about it. It's like, wow, I wish I'd been long that thing. Yeah. But as a value investor, how do you mentally process that? Because it goes against, everything that you believe in.
This kind of goes back to my point I was trying to make earlier about it's not just you have to believe that the fundamentals will ultimately apply, but you have to also understand that there are times where these valuations, the anomalies can be so big that they just don't make any sense. But that doesn't mean they're going to last. It doesn't mean it's going to continue, because you believe in the long run it comes back to some kind of reasonable level.
But you have to have investors who are willing to...
this was the other thing we could talk about.
Yeah.
It's not just about investing, it's the business of running an investment.
Exactly
business.
right.
There's a different set of things about that. But I think from time to time, I have been witness to some of the most extraordinary misvaluations that I would never have dreamed that I would see. And we'll come to the Asia crisis in a minute, which is on the other side of that. But the valuations in the tech bubble were so extraordinary, and I just luckily we actually tried to keep that tech stuff smaller as it went crazier and crazier, and we just hung on long enough and survived, but just barely.
Yeah.
And the irony is, by the way, that coming out of that, we had longs and shorts, and our longs were doing okay, but they weren't going up nearly as much as the shorts were killing us. So coming out of the tech bubble in 2001 and 2. We started to do extremely well, and it wasn't because of the money we made on the shorts. It was the money we were making on the longs that were out of favor because everybody was putting money in the tech stuff. So I remember in that time frame, we were buying one of the cigarette companies. I think we were buying R.J. Reynolds at 2.5 times earnings, and they had some legal issues and so on. But people were using that as a source of liquidity for the tech stuff. So that was where we made the serious money coming out of the tech bubble, that and the Asia crisis. So the extremes of valuation, you just have to be prepared. And one of the things about doing this for a very long time is that I know that these extremes can go on a long time and can go further and further. I think that's where we are in the bond markets today. That never dreamed we'd see interest rates where they are, but that's where we are. The inverse of that was in the Asia crisis, and we went to Asia in the mid '90s and started looking for good businesses in Asia, and particularly in Korea and in Thailand, Hong Kong, and luckily we could see there were real financial issues developing in Asia, so we didn't do much initially.
But sorry to interrupt, but what took you to Asia in the first place?
Yeah, so I was really lucky. I have a good friend named Gifford Combs, who was going over there with some people that were involved with Soros, and he was kind of tagging along, and he invited me to come. He said, "You won't believe the value. You won't believe what's going on here. You won't believe the valuations." And I want to come back to this because it's part of one of the ways we look at good businesses. The Asian economies were all growing, and in those days, Korea was growing really fast, Thailand was growing fast, and I hadn't seen anything like this. This is really the growth of these economies, and therefore some of these businesses was quite exciting. And so we went and looked, and we could go into great detail about all the stuff we looked at. But the point is, in the Asia crisis per se, we basically avoided most of that. But I started buying stocks as the Asia crisis pushed things down, and there was a small brokerage firm in Korea. It was run by a guy who was actually a North Korean refugee who'd been there, and he came over, and he had this small brokerage firm, and we got to know these people pretty well. We talked to them a lot, and the stock was a simple balance sheet with mostly bonds, government and corporate bonds, and some cash, and then it was leveraged 3 or 4 to 1. You know, Bear Stearns was 30 to 1 or whatever. These guys were 3 to 1. And when the crisis hit all the brokers because of their brokers, and the stocks went down dramatically. So this thing was at about 60% of book value, and it pretty quickly went down to 30% of book value. Well, that's pretty attractive. So I bought some more. And then it got cut in half. And this, by now, you know, Korea is just collapsing. This was late, whatever it was, 98.
Yeah.
And this was real. And I knew the company. I knew the balance sheet. There's nothing wrong with this stock. It's fine. So I bought quite a bit more. And within a month, it got cut in half again. So we're now down to like 8 or 9% of book value.
Yeah.
I've never seen anything like this. These are leveraged bond portfolio at high quality bonds at 9% of book value. So I bought some more, and ultimately it worked out, and the stock went up 10 times.
But mentally, this is what I'm so fascinated about, because this is, you know, the modus operandum of a short seller, of a value investor, I beg your pardon, is clear. It's straightforward, and it looks so easy. As I said that when I'm talking to Dave Ivan, it sounds so simple. It looks so easy, but the battle up here, even though you know that company, you know the balance sheet, you know the people, how do you deal with that when you've had something cut in half and half and half and half?
Well, I'll tell you, it was scary. I don't want to sugarcoat it. But I think this is one of the things that we do, I think a lot of value guys do, that's different than most others. And that is, we're very much involved in the research.
Yeah.
We're very much involved in looking at the company, talking to the managements, and that gives you a level of confidence in what this really is.
Yes.
And I think one of the things that bear markets scare people out of positions because they don't really have confidence in what it is that they're owning or buying. And so we think it's really important that portfolio managers are also analysts and get involved with the managements as well. We're involved with some things right now where the stock was going down every day, and it was, you know, one of these things where, well, what are we missing? Well, we don't think we missed anything, but it is hard to do because certainly if you're not really knowledgeable about the asset and the business and so on, you can get pushed out of these things. So that's one of the answers. The other thing, I think, is just personality. I just, for whatever reason, have this streak that I'm a contrarian in general, and the worse things are that people think they are, so the more comfortable I am in doing it. And conversely, the more comfortable people are, the less I am in what's going on. So I think that's a personality trait that, you know, some of the people I know that are pretty good at this have the same defect that I do. But I sometimes think, thank goodness I found this line of work because I couldn't do this and a lot of other things. But these were some of the real crunch points in my experience that were really required me to think very carefully about, first of all, did you make a mistake?
Yeah.
And secondly, if not, you know, how much more of this can you take? How much more of this do you want? You know, the arithmetic here, I think, is for me is very appealing. We get a lot of people that talk to us about volatility versus risk, and as you know, value investors think risk is not volatility. I think volatility is not risk. So this was a very volatile stock, and this is a good example of the kind of distinction that I think value investors make. If you think about this particular company, and if you think about what the assets were, and then forget about the business. The business was okay, but it wasn't great. But just think about the assets that you're buying at what price. I think a lot of people today that think volatility is risk would have taken this experience and say, at 10% of book value, this is a very risky stock.
Yeah.
We come to the exact opposite conclusion. Yeah. The idea is that as a price of an asset goes down, it is less risk, not more. Even if it goes down, whether it goes down quickly or slowly, if it's going down, it's getting less risky, and the speed with which it goes down is irrelevant to us. So we don't think this was, I don't know what the volatility on this stock was, but it was very high in those days. I think it was getting less and less risky as it goes along. But in addition to that, the expected return is going up.
Yes.
So this is value investing is one of the only strategies I know of where you simultaneously, as things get cheaper, reduce the risk and increase the particular expected potential return.
The thing that strikes me about that, because I agree with every single word you said there, but the X factor, I think, if you go back to the Asian crisis you said there, you go back to that list you made at 10 o'clock at night, you did the work before, so you were ready, you knew what you wanted to buy. I think if you already own these things, that's why I'm very interested in your thought as it got cut in half and you're long the stock. It's very easy if you've got a list of things that you want to buy when they go on sale, you're rubbing your hands as the markets are falling. When you're long the stock and it's getting cut in half, and so's the value of your stake, that's a much harder thing to step in and say, the risk is going down, this is great.
Depending on how much liquidity you have left, that's really a critical question. Yeah. And we oftentimes use this example when we're interviewing young people and say, if you buy a dollar bill for 50 cents, which is what value investing supposedly is it a good thing or a bad thing if it goes to 40 cents? And the answer to that question is oftentimes revealing of the candidate that we're looking at, because most people will say, well, it's a bad thing. Well, it depends. The answer is it depends.
It's your time frame. It's always time frame.
Have you got any more liquidity?
Yeah.
So you'd be unhappy if you spent all your money on this before. But if you've still got some more liquidity, at 40 cents, you get this dynamic I was just describing. You have now, instead of making a potential 100%, 50 cents on 50 cents, you now have a potential 150%, where you make 60 cents on 40 cents. And simultaneously, the risk is less. So the more that happens, even if I already own it, I'm not unhappy about it so long as I've got the ability to put more money to work in that position. And the position's getting smaller. Now, the inverse of that's true on the short side. That's another reason that shorting isn't the inverse. But as a position in your portfolio goes down, it gets smaller and it gets more attractive simultaneously.
Only when you truly know a company, can you understand the idea that a stock actually gets more valuable as it declines. And it's that same knowledge which also gives you the confidence to step in when those who haven't been as thorough in their research are panicked out of their positions. And as Bill gave me a tour of Miami's construction boom, the idea of value being detached from price was crystallized. But it's identifying and understanding the differences between Bill's early experiences and the current landscape that potentially give us an insight into what the future might hold in terms of opportunities if we have reached another major turning point.
What I want to talk to you about is, and we touched on it earlier on, the fact that the times we're in now are an absolute mirror image of your early days in the industry. So I'd love to get your perspective and the way you think about the current environment, given how you started your career. When you look at the landscapes, I mean, you and I have talked about this a lot over the years, but just give me a summary of how you think when you look at today's environment.
Well, this is sort of the reason that I've decided to get back into the business of investment management, the name of our fund, and all of that reflects that very observation, that we are at an extremely extended, anomalous time with the debt buildup and the monetary policy, which is designed to attenuate that. So today we're in this extremely stretched, extended situation. And the financial conditions are the mirror image of what they were in the late 70s, early 80s. You have massive liquidity everywhere, floating asset prices and all kind of things, bubbles and all kind of things. And so, indeed, I think it is a mirror image. And I think it's also, to some extent, similar, but the timing is a little bit different. At this point, the central banks are changing directions. I don't think there's any doubt about this. And that was not clear until the moment it happened in 1982, and then markets started to move immediately. Here we've got the change of direction. It's been kind of coming for a while, and markets are beginning to change a little bit. But the thing that we think is interesting is that there is this huge buildup of debt and this massive monetary stimulus around the world, the developed world, and all of this we think is either tapering or it's actually, in the Fed's case, reversing. This is a hugely important moment in financial history. We think this is going to change a lot of things. And the other thing that's interesting is I don't think the markets have adequately discounted this big change.
Right.
So for us, this is good news. For us, this means there are opportunities to take advantage of this change. Now, as we've talked earlier, shorting is a very risky thing. We don't do it easily or often, and it's not something that we're particularly good at. But we think today we see some opportunities on the short side that are very low risk, high return, the inverse of what we normally have seen in shorting. And for us, that's a really interesting opportunity. Also, as things change and markets change and so on, oftentimes we find new opportunities in that change that will be profitable for people like us. But right now, we think there are some very interesting, low risk, high return shorting opportunities, and that's a big change from what we've seen, in the last 5 or 10 years.
Well, we'll talk about a couple of specific ones in some detail shortly. But just coming back to when you said this is the reason you got back into the industry, and you touched upon the name of your fund, and I don't want to tell that story because I think you should. Perhaps you can. Was there a moment when you either threw down the Wall Street Journal or closed your browser and said, "To hell with this"? Was there a defining moment that made you say, "All right, I've got to get back in the game"?
Well, I've been when I moved down to Florida, I became a consultant to my firm in New York, and we had a small family office down here. I love this. I call it a game. I don't want to quit. And I've said earlier, I wanted to be in the business. So a couple of years ago, we started a new fund, the Eschaton Fund. And the definition of Eschaton, I don't know if you know this.
No, I do know this, but there'll be people that won't know it. So I want you to tell the story because it's a great
So Eschaton is the old ancient Greek word from the New Testament that meant the day of judgment. And this may be a little overstatement, but a little extreme. But we think we are at a very important turning point in financial markets, and the name is designed to indicate that. The way I like to put it is that the growth in debt and the central bank policy that has come with it is reaching a climax. Now, I don't know whether that means it's an end or an extension or an extreme or some kind of a response to this, but I think this is coming to some kind of climax, and I think that's going to give us, or is giving us, some really interesting opportunities as value investors.
So your point earlier on about the real returns are made coming out of the down cycles,
right? So have been historically for us.
Yeah, for you, exactly right. So I'm interested that you're looking to get in ahead of that down cycle this time, which is, I guess, a departure for you.
Well, this is one of the interesting things about this moment in time.
Yeah.
I don't remember, I guess in the 07, 08 period with the housing bubble here, we saw some of the similar kind of things. But today's environment, we're not going to make as much money. You can't make as much money in shorting, but I think we're going to make significant amounts of money in low risk shorts. As you know, we have significant bond shorts. Yep. And I think those, I don't think there's much risk in those anymore. There has been, but I think the risk in shorting bonds, particularly in Europe, and also some other places, we're short some Canadian bonds as kind of a proxy for the U.S. And also, as you know, they've guaranteed a lot of risky housing, and some other things we've got in the bond market we think are pretty attractive. And the other area which we find low risk and particularly attractive are shorting the financials of Australian and Canadian banks that have funded this massive another credit cycle bubble in real estate in those two countries. And as you know, we just got back from Toronto last week, and my analysts are going to go to Australia in a couple of weeks. But we have a pretty big position in short position in these financial companies that have funded and are funding this massive real estate bubble that's basically twice the size of what ours was in 06 and 07.
Well, so let's dig into this a bit, because it is an interesting subject, and it's a subject that no one's going to find this news. We've all been talking about these for a while, so I'm interested to understand why now. What are the triggers? What are the catalysts? And which companies are at the epicenter of this? Right. Let's start with Canada. We'll save Australia because I know a bit more about the Australia thing.
And I do too. And we think Australia is considerably more interesting, but it's very similar in both countries. I guess one of the things that I've learned to do after painful experience, and he talked about the shorting the tech bubble, I've just decided when we get a good idea, particularly on the short side, I just want to wait. Yeah, I'm just impatient, take some time, and the further extended it goes, the more attractive it is. At the same time, we're looking for the end of the credit cycle, the end of the credit expansion, and now I think we're finally seeing that. So that was another reason to wait. So the Canadian and Australian housing property bubbles have been developing for a long time. I just read the other day, Australia, and I'll start with this factoid, over the last 55 years, has seen the greatest appreciation of property in the world. Mm-hmm. And Canada is not far behind. Again, if you look at credit bubbles and credit expansions as measured by private sector credit to the GDP, you see in the last 20 or 30 years, you see Japan, you see Spain, you see the U.S. housing bubble, Southeast Asia. And today, if you look at those same calculations, you see China, not surprisingly, you've seen a massive increase in a very steep line that's increasing credit. But at the same height, which is about as high as Japan and Spain ever got, you also see Canada and Australia. People aren't nearly as conscious of the fact there's been a very large expansion of credit in those two countries, mm-hmm. and it's not government credit, it's private, in the private sector. And most of it is in consumer, and most of that is in mortgages. And that credit has floated a property bubble in those countries, which has gone on, as you know, for 25 years. And it's gotten bigger and bigger and bigger. And in 2007 and 2008, it kind of flattened out, but it never went down. Those two countries did not have a recession. I think a lot of people understand that most of the reason is that there was Asian money that was coming into those countries that helped it skate over the downturn in housing and also the downturn in the economy, the global economies. So they never really had a recession and certainly didn't have a downturn in the housing prices. Coming out of that, the house prices started rising again, and they've been rising ever since. And they're now at levels in both countries that are about twice the peak in the U.S. We look at house price to income levels as a sort of a simple way of looking at affordability of housing. Yeah. And they're about twice where they were at the peak here. And they're concentrated in big cities. In Canada, Vancouver sticks out as a very overvalued property market. Toronto has come back lately, and they're starting to do the same thing. And not surprisingly, this has been funded by massive issuance of mortgage debt by the banks. and it's also supplemented these days by very large HELOC borrowings. And we're trying to get a feeling for how these houses, how people can afford these houses, given the ratios of income to house prices. We think there's a fair amount of fraud, or there's an amount of extension of credit to people that really can't afford it. They're breaking the rules in all kind of ways. I think Canada is quite interesting, and I think these banks are going to have a real liability problem from the bad loans. But they're only setting up provisions about 25 basis points, so they're massively under provisioning for what we think is about to happen. So if you take that model and apply it to Australia, it's even more extended. Housing prices in Australia are extremely expensive. And the banks there, the big four banks, these days have about $1.8 trillion of mortgage debt outstanding. It's very large.
Well, for a country of 20 million people.
25 million people, that's big.
Yeah.
Also, in Australia, you've had a much larger than in Canada, a much larger percentage of the house buyers are what they refer to as investors. So in the last few years, if you look at the statistics, mortgage issuance, about half of that has been to, quote, investors. Yeah. Well, the investment prospect in both of these markets is not very bright, which means people are basically speculating on the housing prices going higher. So here's the arithmetic in Australia for an investor in a house property. You buy a property with whatever money down, and you get a rent for that property, which is going to give you about a 2.5% or 3% a year income rental yield on the price that you pay for the property. But the mortgage debt that you're taking on to fund that property is about a 4.5% in cost. So you're borrowing money at 4.5% to invest it at, say, 3%. So you're losing money every year on the carry, which tells you that people are doing this because they're so sure that they're going to make money on the appreciation. So we've watched this develop over the last few years and trying to understand how it's come about over many, many years. And we talked about this earlier. It's really interesting. Unlike speculation in stocks and so on, the speculation in residential property seems to be just irresistible.
Yeah.
And people are breaking rules and taking on risks that they shouldn't take, and most people wouldn't take. They're losing money on the carry because they're so seduced by the increase in value of equity that's leveraged to the rise in housing prices.
Yeah.
So if you have something leveraged 3 or 4 to 1, you get a 5 or 10% increase in the price of the asset. You're getting 3 or 4 times that in the value of your speculation. And that, I think, is the reason why these things are so hard to kill, they're so hard to slow, and the reason that people take all these risks and chances in owning these things, because they think it's just irresistible.
Well, people have been conditioned that property prices go up. Yeah,
well, in these markets, anyway, we kept asking people we talked to, didn't you see what happened here in 2008? Don't you know what happens to property bubbles? And invariably, we're different.
Yeah.
It was always,
sure.
But Canada's different. We're not like you. Well, it's true. We're not. We're like twice as leveraged to this.
Yeah, but we have all the Chinese buyers coming in. We get
the argument over and over again. We have immigration, and we have a shortage of area space. Well, this is Canada.
Yeah.
And Australia. There's no, this is a hard thing to swallow. So anyway, it's very attractive, we think, as a short prospect, because again, these particularly Australian banks are very, very exposed to the property bubble. They have 2/3 of their assets in mortgages. We've never seen anything nearly that high before. It's huge, a massive amount. Again, virtually no provisioning against bad loans, because there aren't any bad loans. We saw this. This is exactly the same thing we saw here in 2006 and 2007. When real estate prices are rising, nobody's going to default on their loan.
Right.
They're not going to you're not going to be able to foreclose on it or have to foreclose it because they'll find some way to finance it. So there's absolutely no experience of bad loans because nobody's going to let that happen in a rising market. So we hear over and over again, but these are good credits because there's no non-performing loans. We're pretty sure that a lot of these people are stretched. A lot of people can barely make these payments. We're pretty sure we see people borrowing money against their equity in their house to make the interest payments on these things. We're seeing people buy 3 and 4 properties with taking out the equity in a HELOC loan to make the down payment on another property. This has been going on for a while. So all of this is telling us that this is a very extended property bubble, and it's been funded by the banks in these 2 countries. And that's, I think I'm pretty comfortable that that's what's been going on. So the couple of things that are going to make this change, are going to turn this bubble over. One is just simply rising interest rates, as you see in Canada, and I think you're going to see more in Australia. There's going to be rising interest rates, and the servicing of these loans, of these mortgages, is going to be really difficult at higher rates because I think people are really stretched already. Yep. We're starting to see some of that already. The other thing that's happened is that a year or so ago, both of these countries began to have more and more sort of social issues about the people that can't afford to buy houses. Mm-hmm. And so they've been putting into place various laws, regulations, taxes, and so on about foreign buyers, about people buying properties with interest-only loans, which are very attractive to speculators. They've been clamping down on the people that are buying either foreigners or speculators to try to contain the housing bubble. But the irony is, I'm not sure what they want. They want to contain it, but do they want to make it? Do they want to roll it over? Do they want it to go down? This is a dilemma that they're going to have to face. That's been happening in the last year or so, and sure enough, housing prices in both of these markets have flattened out and started to roll over. And in Toronto, for example, housing transactions, which usually lead the prices, are off over 40% year over year. Mm-hmm. So this has had a big impact on transactions. The prices have started to flatten out, actually maybe turning down a bit. So we think this bubble is starting to roll over from those provisions, the regulatory provisions, and from the rising interest rates. And on top of that, we now have in both countries a recent event, that's going to make credit to the housing market much more difficult to get. In Canada, they put a new rule in effect which forces the banks to stress test a mortgage where the issuer has to be able to meet the debt service at 200 basis points higher than their current mortgage rate. This is called Rule B20. It went into effect January 1st. And I think this is really going to have a serious impact because I don't know how people can afford to pay almost twice the amount of debt service that they've been paying.
Rates there are like three
or so. Yeah. So you've got to be able to pay 5%, say, on your mortgage. That's a much different problem than paying 3% when the prices are this high. In Australia, as you know, there's an inquiry that started last fall. There's a royal commission.
Royal commission, yeah. That's no inquiry. That's a royal commission.
Okay,
there's royalty involved here.
Okay, this is serious stuff. Yeah. And the discovery that they're coming up with is really amazing. The royal commission basically has discovered that there is really large-scale liar loans in Australia. Last fall, it was estimated that a third of all the loan documents are inaccurate. That's a big number because everybody's got a house. They also have now begun to discover that some of the reasons why these loans get passed, there's been significant bribery for fraudulent loan acceptance of fraudulent loans. They're using a standard for sort of a regulatory standard for expenses for a family of 4 or whatever in Australia that's far below what it really should be. So again, you've had this experience of having lots of rules bent such that you be able to borrow money that you really can't afford to borrow to buy a house that you really can't afford to have. In addition to all that, you have all this speculation. It looks to me like you're about to see a serious downturn in mortgage issuance in Australia, and UBS has estimated that it's possible to have a 30 or 40% decline in mortgage credit in the next couple of years. If anything close to that, this market's in real trouble. So if that happens, both of these countries are going to have, the banks are going to have serious non-performing loan issues. I think the Australian banks, which are paying out a pretty big dividend right now, are going to have to cut those back. These banks are all fairly highly levered, and that might be a problem if they start actual loans. I think the whole thing can contract. And as you know, one of the things about all these markets, but particularly the property market, it's very reflexive. So as this begins to happen, it feeds on itself. Sure. Prices start to fall. There's more stress. There's more bad loans. The banks get cut back more, and it goes around and around, and creates a declining property market with the impact on the banks that are heavily leveraged, having a lot of bad loans. One other really important distinction for us between Australia and Canada is that in Australia in particular, the loan-to-deposit ratio, which we look at, is much higher. I think it's 120, 130% as compared to the amount of loans to the underlying deposits are at that kind of range. Now, typically that means that gap is filled by wholesale financing.
Funding, yep.
And we saw this in Spain in 2007 and 2008. Lots of outside deposits coming in and into these banks. This is hot money, and when these companies get in trouble, when they start to have bad loans, when the Fitch last week downgraded the Aussie banks, I think they're going to have a liquidity issue on top of all the rest of this. That the Canadians are not as vulnerable to this as the Australians, but I think you're going to see it could be a really serious liquidity issue, which will again further and accelerate the contraction that you're going to see in the credit for these markets, and therefore in the value of the properties, and therefore much bigger loan losses for these companies.
Australia is a place dear to my heart, but I've watched the housing market there expand dramatically for years, waiting for the opportunity and, importantly, the means by which to short that particular bubble. So I was fascinated to hear more about Bill's approach to that idea.
Let me play devil's advocate here, and I'm going to stick to Australia because I know a lot more about that than I do the Canadian market. But in Australia, people need to understand that property ownership in Australia it's almost deemed a birthright. Everybody owns a home. The price of those homes have been unaffordable for years. I moved to Sydney in 2005. Couldn't afford to buy a house there, having sold one in Greenwich, Connecticut. I mean, it's ridiculous, the prices then, and they've only gone up since then. In 2008, when the housing market started to crumble, the first thing the government did was give us $6,000, I think it was, first-time buyer grant to try and it kind of worked. It went up again. And people have been talking about this scenario that you're talking about. I've talked to people all around the world for the last 7-8 years, and they've all said, we want to short the Australian housing market, and the only real way to do it is through the banks. Because there's no Toll Brothers, there's no Lennar Homes in Australia. There's no equivalent that you can short the home builders. And the problem, you touched on it, that the Aussie banks are A, systemic institutions, B, they pay enormous dividends, which means everybody owns them for the dividend. And there's been a lot of work on this. Jonathan Tepper at Variant Perception has done some incredible reports about the housing market. He and John Hempton went around posing as a gay couple at the auctions in Sydney to see how the whole thing worked. And I think Jonathan's report was called "I Know a Man Who Can Get Things Done," and it was an extraordinary expose on the Australian housing market. And they got absolutely carpeted in the media for this thing. I mean, if you attack the housing market, you attack the Australian housing market, it's un-Australian. You just don't do it. And so, I'm really interested to understand, why now? Because I think there's going to be a lot of people that say, why now? And the Royal Commission, I think, is a trigger.
Well, one of the answers is the Royal Commission and interest rates and other things. And we're aware of this. I've been watching this for years. Again, part of my what I've tried to do is to be patient in all of these ideas, and we just keep waiting until you see the credit rolling over. You see, and the longer you wait, the more extended it is. So if you went to buy that same house today that you were trying to buy 10 years ago or so, it would be 2 or 3 times as expensive.
Yeah.
So how do people afford to buy it? That's the real question. Yes, interest rates are lower now than they were, but how is this afforded? And our explanation for this is that there's the documentation, the standards by which mortgages are issued just simply cannot. You can't get prices this high with a reasonable set of standards for mortgages. So that's what's got to be weak. It's either fraudulent or the standards are too low, and so all of a sudden the Royal Commission is finding that to be the case. So now I think that's the answer as to how this has kept going. As to why it's not going to go any further, is that one, I think it's already extended about as far as it could by any standard, by any structure of the way the mortgages are issued. And two, you're starting to see rising interest rates. That just pulls credit out of everything. And then they're going to really enforce, I just read an article today, they're going to start really enforcing the strict standards about issuance of credit. And you can't possibly issue mortgage that would justify the current price of the house anywhere close to this. So, I mean, maybe something will continue. I had somebody tell me in Toronto the other day that, well, every time people get worried about housing in Canada, some magic happens.
Right.
Okay, well,
that's great.
He literally used that word. So maybe magic happens again. I don't know, but this is the kind of thing we look for because structurally, this cannot be sustained, and we can see it. We've seen this movie before, by the way. We did all this in 2007 and 2008. And the other thing that makes this particularly attractive now, which we didn't do this earlier, other people did, and the short interest in these things have gone back to nothing. There's almost no short interest. The other thing is, again, back to valuations. These banks everywhere, Canada and Australia, are very expensive. And the point I want to make about this in terms of why we find this so attractive, I said earlier, shorting is very risky. We don't like to do it. So we want to have very low cost, or very low risk short opportunities. And banks at 2.5 times earning, or 2.5 times book value, are just almost can't go any higher, almost don't go any higher. So we have a cost of carry. There's the dividend. As long as they pay it, there's a little. So it's not free, but we don't think there's much risk of this stock going up much. And we had that experience here in 07 and 08. So you have a short that's asymmetrical in that there's not much risk to losing money as it appreciates, and we think there could be, don't know, but there could be a significant decline in the value of this asset, the bank, because it's very leveraged. So banks are leveraged 25 to 1 or whatever, with no loan loss provisioning, and they're not very profitable banks. Their profitability is pretty mediocre. So you get a systemic problem in their loan book. They're not making anything. And so they're selling you 2.5 times book.
Now, are you looking all the big four, Westpac, NAB, Commonwealth, ANZ, or any of them stand out to you as particularly weak?
We think Commonwealth and Westpac are probably have been a little more aggressive.
Yeah.
I wake up every morning, I read the testimony from the night before at the
Royal Commission.
The Royal Commission. The stuff is amazing, the stuff they've done. I think it was yesterday, Commonwealth announced they've lost the records on 20 million accounts.
Yeah, that's right.
Did you read that?
Yes, I did.
Like, wait a minute. So there's this thing over, and there are other things that the Royal Commission is finding that these banks have done wrong. Credit cards and the advice to people is also, they have other problems. But the interesting thing is, they're going to get slapped on the wrist, and they're going to get fined, and it's embarrassing, and some people are going to get fired, and there's some bribes paid. But most of the analysts seem to be missing the fact that this problem is going to get solved by tighter lending standards.
Right.
And that's the real killer for the Australian market. Tightening lending standards means lower prices of houses. And the same leverage we talked about before, as prices appreciated and people find irresistible, this ever-rising, accelerating value of their equity is going to do the same thing in reverse. Well,
the beauty of housing bubbles is that there's only one variety. It's the same story, any housing bubble, anywhere in the world, at any point in history. It's exactly what we've just laid out. So you kind of know, once it bursts, you know how the dominoes are going to fall.
As my director of research likes to say, once the bubble is rolled over, starting to roll over, it's not going to flatline. It's right. You can't have a bubble that just stays stable. It's going to go up or it's going to go down. We see this rolling over, and we think there's a big downside to these stocks. There's leverage. There's all the provisioning they're going to have to put aside. And if you get this thing in Australia with wholesale money leaving.
That overseas wholesale funding is a big problem for them.
And nobody's talking about it. We don't see this in the analyst reports that we see. We don't see people talking about it. And again, you see this thing while we have immigration and a shortage of land. And the Chinese flight capital is probably a lot less than it was a few years ago, as China has reduced their ability to get money out of China. I don't know what's going to make the way we think about it. We don't know what could make this these stocks go up a lot.
Yeah,
they might not go down as much as we think, but we don't see a downside in shorting them. And this is another reason that the valuations, and it comes back to the bigger point we made earlier. We're at the other end of this long historical period where you get opportunities like this, where you have an asymmetry in risk reward in shorting, which you almost never see any other time.
Yes.
So we think that's particularly attractive now, and that's one of the things we're trying to take advantage of. I think these property bubbles that we've seen, which are huge, $7 trillion worth of property in Australia, we think this could be a very, very profitable short that doesn't have much risk. This has been a 40-year cycle. It's not a cycle. This is a historic turning point. And I don't know that you're going to see really cheap stocks in the very near future. I don't know that you're going to. I don't think that the model that we've had in the last 20 years or 40 years, where the economy turns down and the central bank rushes in and pours money back into it, and this thing takes off again. I ask young people all the time, when was the last real bear market? Has anybody seen a real bear market?
Sure.
The last real bear market was the 1970s.
70s, yeah, sure.
They've had crashes and contractions, and people are conditioned to buy those bottoms. And I'm not sure, but that's a mistake this time. I think you may well see a much more extended period where stocks don't get cheap enough for some time.
But I mean, can we?
Now, these are stocks that they're like what we're talking about now.
Sure, but I just, as an overall market theme, when I think this through and I think about how this plays out, I struggle to come up with a scenario where we get a grinding bear market, because there is so much leverage. You don't gradually work your way out of leverage in a gently falling market. The leverage bubbles tend to burst, and that means sharp drops in asset prices right across the board. So, how do you think about that? How do you think this plays out?
So this goes back to my point about real versus nominal interest rates.
Okay.
I think if you have a scenario where you have rising inflation, and look, I'm not an economist or a macro guy. I don't know what's going to happen. But I think you may well see real interest rates don't go up very much, and it may not have this devastating effect on all this debt outstanding, because the rising prices will help mitigate the debt outstanding. I don't know. I mean, we'll see what happens. We're opportunists, and we don't need to have an answer to those questions today. We see some really exciting opportunities. And on the long side, we like the energy area. We like the emerging markets. So we have a long exposure right now that we think is particularly attractive. These have been stocks that have been through a downside of the credit cycle. The energy industry has had a massive decline in capital expending for the last 4 or 5 years. Some of the emerging markets like Brazil have had the same thing. So we have some longs right now that we think are attractive. And then we also think that these particular shorts are low risk, high return ideas. And we'll see what happens in the valuation of everything else over time.
So how do you think about positioning yourself for this event? Because obviously it feels as though, particularly the Australian thing, the Royal Commission report will be published in September. So you have this kind of a line in the sand there when this thing's going to come out. And at that point, realistically, if you're right, you should be proven right or wrong pretty quickly. I mean, I'm sure this thing's going to get leaked before that. So you've really got 3 or 4 month window.
I'll argue that this is happening today because all those people that are having to testify before, and you've seen Mrs. Orr speak to this. I wouldn't want to have to talk to that lady. Those guys are tomorrow morning are going to tighten up their lending standards. You're not going to wait for the commission report to come out. They're going to change tonight because they're going to have to.
But that doesn't really matter for the market, right? The effect, that'll take a while for the pig to go through the python. It's really when the damning report comes out that brings it to everybody's attention that this is what they're going to have to do. I mean, they can tighten lending at the margin.
But that's the key to this idea.
Right.
At the margin, there's not the credit available. And as the UBS guy in his report made the point, housing markets are not about the supply and demand of houses. It's about the supply and demand of credit.
Right.
And to the extent that the credit spigot is getting turned off now because of this embarrassing testimony and all that stuff, we think that the credit spigot is going to determine the fact that the housing prices in Australia and Canada have already peaked and they're starting to roll over. Now, how that runs through the whole system and starts to create bad loans, we're going to see. I would expect to start seeing non-performing loans start to spike up pretty soon.
Having the chance to talk with a man who's experienced a world which is the antithesis of our current environment offered the perfect opportunity for me to try and understand what facets of that experience Bill felt were going to be vital in the months and years ahead.
So given this potential big turning point in the cycle, in markets, in the credit cycle, when you look back over the 45 odd years you've been doing this, what lessons stand out to you that you try and keep uppermost in your mind as you try and plot a course through this?
I think the main lesson is that valuation is the key to help us navigate through these difficult times. And today we see valuations the most egregious, I think, are on the long side, on the short side. And we find there's tremendous opportunities here. And you just have to really stick to your fundamental analysis and take advantage of those as they come. I think the world we're going to see in the next few years is going to be quite different. It's going to be a very painful experience for other people, and that's not something we wish for. But it's an opportunity as a fiduciary of other people's capital. I think it's an opportunity that we should be taking advantage of. But I don't know. I think from my experience many years ago, there is a very long cycle ahead of us while this problem gets worked through. And I don't know how that's going to happen. It could happen through inflation. It could happen through a debt jubilee, or any number of ways this might happen. I don't know how to figure out that. But I think that the last 40 years are turning into a very different financial backdrop, and we try to have a set of financial strategy to take advantage of that.
It's the perfect way to end this conversation. I mean, it is an unknowable future. It's always an unknowable future, but this is why I love these conversations, to try and see what that future might look like through a variety of frameworks. And I really appreciate you taking the time to share yours with us, because I think it's a very valuable one for people to be able to learn from. So,
my pleasure. I enjoyed it. Thank you.
Bill Strong is a value investor, one who learned his craft under the tutelage of one of the finest exponents of that discipline to have ever graced the world of finance. He seeks out good businesses and then insists on underpaying for them. It's a tried and tested method which is a lot harder than it seems at face value. By his own admission, he doesn't like to sell short, and he doesn't feel as though it's something he does well, but the last 2 times he's taken on short trades, 1998 in Asia and 2008 in the United States, he was spectacularly successful, both in capturing the fall and then, importantly, in picking up the kinds of assets he covets at fire sale values, ensuring they would generate tremendous returns as the market stabilised and recovered. There really isn't a better backdrop than the booming skyline of Miami against which to discuss Bill's fears for the Canadian and Australian housing markets. And to me, the fact that the greatest opportunities this most reluctant of short sellers sees are both on the short side of the market suggests that it's time for us all to at least reassess where we think we are in the cycle. I'm incredibly privileged having these opportunities to spend time soaking up the lessons learned by people like Bill. And as Miami was slowly enveloped in darkness, and with his words still fresh in my mind, the symbolism was anything but lost on me.